What a day for the markets, folks. What an absolutely wild, unprecedented day, especially if you've been watching silver. Just this morning, we were looking at silver hitting an incredible all-time high of 83. It felt like the sky was the limit, the momentum was unstoppable, and everyone was piling in. But if there's one thing we know about the markets, it's that they are unpredictable. What goes up, especially that quickly, can come down just as fast. And that's exactly what we've witnessed today. In a stunning turn of events, the price of silver has taken a nosedive. We're talking about a more than 10% drop in a single day. As I'm recording this right now, the spot price for silver is hovering around 73. That's a $10 drop from its peak just hours ago. A 10% swing in a major commodity like silver in one day is virtually unheard of. It's the kind of volatility that makes headlines and has everyone, from seasoned traders to casual observers, asking the same question: what on earth just happened? So, let's break it down. What was the catalyst for this massive sell-off? The primary trigger appears to be a major announcement from the CME Group, the Chicago Mercantile Exchange. They are one of the world's largest exchange operators, and they made a crucial decision that sent shockwaves through the market. The CME Group announced they were raising the margin requirements for trading silver futures. Now, for those of you who might not be familiar with what that means, let me explain it simply. Margin is essentially a good faith deposit you have to put down to open a futures contract. It's like a down payment. When an exchange raises margin requirements, it means traders have to put up more of their own money to hold onto their positions, or to open new ones. This makes it more expensive to speculate on silver. Think of it this way. If you were borrowing money to buy silver contracts, you now suddenly need to come up with more cash to keep those positions open. For many traders, especially those who are highly leveraged, this is a major problem. They are faced with two choices. Either find more cash, which isn't always easy, or sell some of their silver holdings to meet the new higher requirement. And when a lot of people are forced to sell at the same time, what happens? The price drops, and it drops fast. This is a classic case of a margin call cascade. This move by the CME Group is often seen as a way to cool down a market that's getting too hot, too speculative. When a price runs up as fast as silver did, the exchange gets worried about extreme volatility and the potential for defaults. By increasing margins, they effectively reduce the amount of leverage in the system, forcing some of the more speculative money out. And boy, did it work. The announcement was like pouring a bucket of ice water on a red-hot market. The selling started almost immediately and just kept gathering steam. What's really fascinating about this situation is the human element. We're not just seeing numbers on a screen. All across the country, we are seeing real-world consequences. Reports are flooding in about long lines forming at coin shops and precious metal dealers. But here's the interesting part. The lines are going both ways. On one side, you have people who see this dip as a massive buying opportunity. They've been waiting for a pullback, and now they're rushing in to buy physical silver, trying to buy the dip, believing in the long-term value of the precious metal. They see $73 silver as a bargain compared to the $83 it was this morning. They are convinced this is just a temporary shakeout before the next leg up. But on the other side of the coin, literally, you have people who are panicking. These might be folks who bought in at the top, perhaps at $80, $81, or even higher. They saw their investment drop 10% in a matter of hours, and they're terrified it's going to fall further. They are lining up to sell their physical silver, trying to cut their losses before things get worse. Their fear is palpable. They don't want to be left holding the bag if the price crashes back down to where it was weeks ago. This creates a fascinating tug-of-war in the physical market. Dealers are being swamped with both buyers and sellers, creating logistical nightmares and massive price spreads. The price a dealer is willing to pay you to buy your silver is much lower than the price they're charging to sell you silver. This gap, known as the bid-ask spread, widens dramatically during times of high volatility like this because of the increased risk for the dealers. They're trying to manage their inventory amidst chaotic demand and supply. So where do we go from here? That is the multi-billion-dollar question. The bulls, the silver optimists, will argue that this was a necessary and healthy correction. They'll say that the market needed to flush out the weak hands and the excessive leverage before it could resume its upward climb. They still believe in the fundamental reasons for owning silver: inflation concerns, industrial demand, and its role as a monetary metal. They'll point to the long lines of buyers as proof that underlying demand is still incredibly strong. For them, this is just a temporary setback. The bears, on the other hand, will see this as the top. They'll argue that the bubble has popped. They'll say that the rapid price increase was purely speculative mania, and the CME's margin hike was the pin that pricked it. They will point to the sellers lining up as evidence that the confidence has been broken. They might predict that the price will continue to fall as more margin call-related selling unfolds in the coming days. They might be looking at targets of $65, $60, or even lower. The truth is, nobody knows for sure. The next few days are going to be absolutely critical for the silver market. We'll be watching to see if buyers can step in and create a floor under the price, or if the selling pressure will continue to dominate. Will the price stabilize around this $73 level, or is this just a pause on the way down? One thing is for certain. Today, as events are a powerful reminder of the risks involved in trading, especially in highly volatile markets. The allure of quick profits can be intoxicating, but the reality of sharp, sudden losses is very real. It's a lesson in risk management. Using too much leverage can amplify your gains, but it can also wipe you out in the blink of an eye when the market turns against you, as many traders found out the hard way today. We are living through a historic moment in the precious metals market. A 10% single-day drop after hitting an all-time high is the kind of event that traders and analysts will be studying for years to come. It highlights the power of exchanges to influence markets and the raw emotion that drives both fear and greed. We will continue to follow this story as it develops, bringing you the latest prices, analysis, and on-the-ground reports. What are your thoughts? Are you buying, selling, or just watching from the sidelines? Let me know in the comments below. This is a fascinating discussion, and I want to hear what you think. Thanks for tuning in to this special update. If you want to stay on top of these market-moving events, make sure you're subscribed to the channel and have those notifications turned on. We'll keep you posted. Stay safe out there and be smart with your investments. We'll see you in the next video.